Right, today we're going to do things slightly differently, and we're going to be looking at the considerations for asset manager selection. And Cobie, let's start off with you.
Yeah, I mean, I think what's important, one of the big things, remember, trustees are liable at the end of the day. So remember, regulation asks trustees to apply their minds. And then also this applies obviously to when they appoint certain asset managers. And when you appoint an asset manager, you need to make sure that at least they're appropriate as far as their selection is concerned. If you look at your screen quickly now, you'll see some of the things that boards of trustees need to be applying their minds to. I mean, I suppose the first one, and really important, is can liabilities be matched? Do you have the assets, and can those liabilities be matched? Important. If you're going to hire the best fund manager out there, maybe that's not important. Maybe it's better to understand if they can match those liabilities. Who will manage the capital? Who is the asset manager then? Who will administrate the fund? We're talking about fund administration here. Do the fees justify segregation, especially if you're a large fund? And some of the other ones. Who will do asset allocation? Are the fees reasonable? And then maybe as another one, who will you choose? Will it be multi-manager? Will it be single manager? Balanced type mandates? Managers can buy equities, bonds, cash, property and everything. Will it maybe be single manager specialists where different people are buying equities, bonds and cash, and somebody is then doing the overarching asset allocation? And then also the all-encompassing and very important question around ETFs and being passive. Is that maybe not something that you need to be considering? Rob, maybe on the back end of that, I mean, what is the starting point for kind of manager selection, especially for, from an investment consulting perspective?
I mean, I think the first thing is, what are you trying to achieve? You're looking at, you spoke earlier in the circle about asset allocation. Who can give you the 65% equity, 35% fixed interest exposure that you want? So first you need to know who's in the universe. Then through screening tools that investment consultants like us use, we then know who are credible guys, who are not so credible, who's strong in certain areas or who is strong in others. So that's where we bring in the portfolio construction element. So let's assume you want to go absolute return. Who are the guys in the universe that we would look at? We then look at all the tools and the analysis we've done over the years and all the data that we've collected, so that we enable to say we think these 3 guys are good or these 5 guys are good. Generally, it's not. It's very seldom that there's only one and it's a clear winner. Most often with clients, we'll recommend a short list of, say, 3. And then we get the guys to interrogate them. We have generally what you call a beauty parade, where the trustees get to interview the managers they present on their businesses. And then they can make a call. Obviously, operational due diligences are required as per the new Regulation 28. But very often, if managers are fairly similar, it's cultural. You need to have a proper fit between a trustee board and an asset manager. It's surprising. We're all people. We all like dealing with people who understand us. And occasionally there's just a misfit.
Well, I mean, you're saying that you give a selection of specific asset managers that might then suit the other party. How do you decipher who is the best and who isn't? I mean, you were saying some guys are good, some guys are bad.
Yeah. We've got scoring methodologies that look at,
How important is past track record when we know that past performance is no indication of future performance? In other words, the quantitative versus the qualitative.
I mean, that's a critical point. And if you go to trustees, that's the first place they're going to start. They're going to look at the surveys. They're going to pick the guy who's done the best and find a reason why that guy should be appointed. Now,
it's not always the best way to do it, is it?
It's definitely the worst way to do it. Look, there's no doubt that if you look at some managers that have demonstrated long-term capability, you can see that. Sometimes you can see managers that are flash in the pan. So you've also got to be very clear on the period that you look at. So performance is one of the aspects, but the obvious other ones are people, process, philosophy, style, price. All of those types of things are scored. We've got ranking systems for that with weightings. We take our clients through those because they obviously they need to make a decision. We're not a multi-manager that comes up with a product. We're advisors.
You don't work with hedge funds, do you?
We don't work. We would advise on them. Typically, our client base has not been big investors in hedge funds, primarily because they're very difficult for people to understand. And we still question whether they've done what they should have done. We've seen quite a few hedge funds overseas going belly up, and really not
here in
delivering.
South Africa, though. Very different scenario that has been
different scenario in South Africa. But people get scarred, and there's no doubt that one considers hedge funds in a portfolio construction, but we just think that they haven't delivered what they should have done, and we think there are better and cheaper ways of achieving the same objective.
Look, you want to put the fear into a board of trustees. Mention hedge funds, because you would have to go to a break in order to ensure that they, decisively calm down so you can actually discuss it. I mean, hedge funds is just, and unfortunately for hedge funds, it's an all-catch phrase. Where if you look at a survey of hedge funds in South Africa, and they're all operators in the South African market, but you get guys that can leverage up to 20 times and other guys who only leverage much less than that.
Cobie,
they're just not equally
Regulation 28
creative.
has increased the allocation to hedge funds. This is what I find fascinating, and we know that we're seeing pension funds not really increasing their quota.
But here's the challenge for hedge funds. The challenge for hedge funds is making and ensuring that what they're selling to pension funds and to institutional consultants at the end of the day, ensuring that they're packaging it in such a way that people can actually understand what it is that they're doing.
Well, what you're seeing overseas is that hedge funds are actually becoming regulated now.
Yeah.
There's more and more interest to have them reporting on a more regular basis and to declare their leverage so that one can see into them more. So the transparency element is increasing in Europe. And I guess with this increase in the Reg 28 allocation to hedge funds, the need to start regulating them in South Africa to some extent is also interesting, and certainly will be more useful for you guys if there's some kind of guidelines and certain reporting standards that they have to comply with. Right?
Rob, we have to wrap up, so let's now just look at some of the issues, the bones of contention that we actually see coming through from the industry. Take us through some of the biggest points that we're actually seeing this year.
I don't know if they're bones of contention, but certainly the topics that are hotly debated in trustee boards at the moment are things like offshore investments. What is the correct allocation? Is it 25? Is it 20? Is it 15? Is it 0? And also, how do you then go and get exposure? How do you do that? Do you use the offshore component of the local manager? Do you go and buy an offshore manager offshore? We've seen South African managers on their offshore components doing exceptionally well, even comparing them against the best in the world. So we do. Our country is spoiled for some really strong capabilities there. The other issues we're talking about at the moment is Regulation 28 and this issue around compliance at all times, because the law is very clear. And it says you need to be compliant at all times, but that comes at a quite a big cost. And we've heard the FSB saying we understand that there's a cost implication, but we're just kind of saying to this degree, because this is in some cases can be very big. I would say those are probably the two major ones that spring to mind. Other than maybe one of my hobby horses, which is sort of trustee involvement in boards for long periods. They're not around for long enough. You get elections, and we all understand the democratic process needs to happen. But some of these matters are complex. Anybody tells you that investments are easy, they're wrong. They're not easy. For trustees whose job it is not to understand investments, it's a very difficult thing for them to grasp. And I would like us to see much longer terms of trustees on trustee boards.